Hello and good day, everyone. Welcome to this RMA Risk Readiness Briefing Special Coverage Series. My name is Stephen Martin, and I lead the Business Solutions Group at the Risk Management Association. The RMA is proud to present this presentation as a complimentary service to our members. If you're interested in membership, you can find all that membership offers at our website, which is rmahq.org. And if you're interested in the risk analysis service and possibly participating more directly, you can contact one of us on today's call. Our contact details will be at the end of this presentation. So today's webinar is the latest installment in our Credit Trends in Commercial Lending series. It's part of the risk analysis service, and it is presented by our partners at AFS, Tom Cronin and Jeremy Charlson. During our presentation, if you have any questions for the speaker, I think you know the drill. Just to submit them using the Q&A function at the bottom of your screen, and we'll address as many of those questions as we can at the end of the presentation. And like we've done before, if we run over, we'll be sure to find ways to get that information out to all of the registers for today's session. So at this time, we're going to do something a little bit different to break the ice, and I'd like to call up a poll question, and we'd like everybody who's participating so far to take a look at this question and to give us your best answer. And it's open now. I think you can see it on your screen. What is your bank's outlook for commercial credit conditions in 2021? I'm watching the numbers click up. Everybody's getting a chance to weigh in. I love it. Some of you think the worst is behind us. Some think we expect further worsening, and some think it's too difficult. All right, it looks like we're getting kind of close to participation on that. How about five more seconds, folks? Make your choice. Okay. Why don't we close the poll, Miriam? And we'll share this. Let's see. There we go. So you should see on your screen the answers to it. And here's where we have 35% figuring the first answer, the worst is behind us. About 22% of you thinking that there's more pain ahead with further worsening in terms of delinquencies and defaults, et cetera. And, you know, the plurality of you are thinking it's just too difficult to forecast. I might be in that bucket. Well, we will be sure to kind of revisit this over time. And it's probably a good chance for me now to turn it over to Tom Cronin from AFS.
Thanks, Stephen, and welcome to everybody joining us today. Last time out, we examined the RAS data for the end of 2020 versus the end of 2019, kind of an annual review. So this time, we're going to go back to our usual month-to-month comparison. And what we'll be seeing today is what's changed for the first month of 2021. And for anyone who's joining us for the first time, let me do a quick review of what RAS is, how long it's been around, and how banks use it. So RAS started in the summer of 2003 as a reaction to the Basel II Accords that said, amongst other things, banks must be able to benchmark their risk ratings. And from the initial 8 pilot banks and $100 billion in outstandings, RAS now has over $1 trillion in exposure, over 700,000 loans, and has been expanded to enable bank-to-peer comparisons and bank-to-market comparisons by things such as collateral, industry, deal size, and geography. So C&I will be first, and a quick definition. Business purpose C&I loans are made to private and public companies with sales sizes usually greater than $1 million. And these loans are manually underwritten and risk rated. And just one other point, loans secured by owner-occupied real estate fall into C&I. So we'll start with our long-term look at the RAS performance stats. And I'd like to focus on the short-term delinquencies, which are in the blue line, and then the non-accruals, the red line. And as we've mentioned a couple of times last year, the delinquency measure is very volatile. And for January 2021, the blue line, 30 to 59 days past due, is up, more than double what we saw in December. And we're seeing a continuation of the M-shaped pattern that we saw back in 08 and 09. And we're going to talk a little bit more about that shortly. Non-accruals, meanwhile, have dropped again. Late last year, the non-accrual rate had climbed to 1.03 from a low of 0.71 earlier in the year, as COVID-19 business closures had impacted businesses. But over the past 2 months, the non-accrual rate has dropped 10 basis points. So let's take a deeper look at each one of these. We're going to start with a closer look at the delinquency trend over the past year plus. And I'd mentioned that the short-term levels fluctuate quite a bit. And as you see here, over the past 13 months, we've seen a high of 1.33% in April and a low of 0.27% just last month in December. And if you notice, each high over this period that we're showing here has been followed by a low 2 months later by at least 60 basis points. And we showed this to a couple of the RAS banks, and Brad Cunningham of Commerce Bank noted that each high occurs what he called intra-quarter, and the lows are at the quarter end. So the supposition here is that RMs might be much more aggressive with their collection activities towards the end of each quarter. And if anyone joining us today has any insight to this, please contact us. Our emails, as Stephen mentioned, are at the end of the PowerPoint, which you'll receive for attending, but we'd be interested to hear your take on what's happening here. So with the big jump in short-term delinquencies this month versus December, I thought it'd be worthwhile to take a look at which industries had significant changes. And right in the middle of the chart, you can see the immense increase in delinquencies for 51 information, and the subsector being cable programming. The next biggest change further to the left is for 22 utilities, and specifically electric power generation. And we also saw significant increases for all 3 manufacturing sectors, 42 wholesale, 56 admin and waste management, and 72 accommodation and food. Now, the largest improvements were for 49 transportation, and the subsector there was warehousing, 21 mining, oil, and gas, subsector support for oil and gas, and then healthcare, subsector general hospitals. So before we move on to non-accruals, we have one more chart that shows the 30 to 59 days past due rate, this time for our 7 regions. And a quick note, in C&I, geography is based on the location of the borrower. So if a bank in California makes a loan to FedEx, we'll tag that loan as being from Tennessee. So here we have the percent past due for each of the 7 regions. On the spider chart, the dead center is 0.0. And the more the data point of your region is away from the center, the higher your past due level. And in the lower left, you see the Southwest is the highest, just over 1%. And the West is the next highest, just under 1%. And at 0.31, the Middle Atlantic has the lowest past due percentage. So overall, non-accruals dropped 5 basis points. And on this chart, we're showing the non-accrual levels for December 2020 versus January 2021 for each 2-digit NAICS industry. And unlike what we saw throughout 2020, there's not much movement for most of the industries at this 2-digit NAICS level. In fact, the only industry that had a significant jump was 21 mining, oil, and gas, with increases for subsectors drilling wells and oil and gas extraction. A couple of sectors did show a good bit of improvement. The most improved was 71 arts, entertainment, and recreation. And this was led by subsectors theater companies and fitness and rec centers. But despite these movements, the sectors with the highest level of non-accruals remain 21 oil and gas, 45 retail, 71 arts, entertainment, recreation, and 72 accommodation. And the subsector within accommodation that's the highest is drinking places. Now here's another look at performance by our 7 regions, this time for non-accruals. And just like we saw with past dues, the region with the highest level of non-accruals is the Southwest, this time at 1.55%. And the bulk of the non-accruals for the Southwest are oil and gas related. But I forgot to mention when we were looking at the past dues by region, that for the Southwest, the delinquencies were not just energy. There were high levels of delinquencies for cable programming, dairy manufacturing, and accounting firms in the Southwest. So the problems are a little bit more than just oil and gas. And the Western Midwest has the lowest non-accrual level of 0.31%, which is 5 times below the Southwest. So my thanks here to Stephen for pulling this map from the St. Louis Fed. This map shows unemployment by county or parish within each state. The darker the purple, the higher the unemployment rate. And I put this into our webcast as an addendum to our look at the performance by geography. And if you focus on the 4 corner states on the left side, you see the deep purples. And this matches the RAS statistics for past dues and non-accruals, as these states, along with Texas, make up the Southwest. So I thought it was just interesting that the highest unemployment rate states also are the highest non-accrual and highest past due. Now we'll switch to risk ratings and a quick explanation of what we do in RAS to normalize each bank's native rating scale. Using the RMA 10-point scale, we work with each bank to map their ratings to the 1 through 10 RMA ratings, with ratings 1 through 6 being pass, 7 special mention, 8 substandard, 9 doubtful, and 10 loss. On this chart, we're showing the trend in percent criticized, which are loans rated 7, 8, 9, and 10, with a section within each column for each of these 4 classifications. Overall, the percent criticized for January has dropped below December 2020. The overall percent criticized has now declined for 4 months in a row, with most of that decline coming from the special mention segments. So this is a chart we debuted last month and was created by Zions Bank, one of our long-running RAS customers. It combines the current non-accrual percentage in the red and the current criticized percentage in the blue and yellow, and with special mention split out. And the criticized is accruing only, so we're not double counting. So each column is showing what is currently in trouble and what might default given adverse conditions. And this chart points out 5 industries that have been or could be severely impacted by the economic stress due to business closures due to COVID-19. Those industries are 21 mining, oil, and gas. Then moving towards the middle, 45 retail, specifically general merchandise, office supply, and direct selling. 48 transportation, air and cruise lines. 71 arts, fitness centers, and 72 accommodation, both restaurants and hotels. Pardon me. And you'll notice these 5 are primarily high human touch industries and have experienced closures or reduced capacity or reduced demand throughout 2020 and now into 2021. Now let's move on to examining the change in balances for every bank in the RAS database. To create this pie chart, we took the percent change in outstandings for each bank, January minus December, and placed each result in one of the 4 buckets. And you can see that 80% of our banks showed a decline in balances when comparing January versus December, not counting PPP loans. And this is a repeat of what we've been seeing for some time now, as customers are apparently hesitant to borrow and banks are seem hesitant to lend. And I thought this was interesting, given the results of the poll question, where most of you were saying it's too difficult to predict what's going to happen. That seems to be what's happening here, is people just aren't quite ready to get back into the market. And so one last look at C&I data. Here we're looking at the change in outstandings for each region, again comparing January versus December. And as you can see, every region has lower outstandings in January. And now I wasn't surprised by that, given the pie chart we just reviewed. But if you think back to the 2 spider charts we had on performance by region, where the Southwest was not doing well, I'm surprised that the Northeast shows the largest decline, and that the decline for the Southwest is basically middle of the pack. I would have thought lending in the Southeast would be curtailed more than just about every other region. Kind of a good money chasing bad scenario. So as we move on to our analysis of CRE loans, let's pause for another quick definition. For RAS, we define CRE as loans where the primary form of repayment is from leasing or renting properties. These are often called investor-owned properties, and examples would be office buildings, malls, and warehouses. So here's our CRE performance chart. And if you think back with C&I, it appears non-accruals have topped out, or at least paused. But with CRE, it's a much different story. At the end of May 2020, the percent of CRE loans on non-accrual was only 0.29%. Now, as of the end of January, the percent of CRE loans on non-accrual is 1.28%. And we saw an increase of 14 basis points from December 2020. And short-term delinquencies, the blue line, are also up January versus December, and are also displaying the same intra-quarter highs that we saw with C&I. And also long-term delinquencies, 60 to 89 days and 90 plus days, rose during this period. So all in all, this is not a very promising picture for the RAS CRE portfolio. So let's take a little closer look at the more recent trend in non-accruals. On this chart, we're looking at each data point since we began collecting data every month, which, by the way, you only get with RAS. Starting with March on the far left, you can see that initially the virus had virtually no effect on C&I properties, as the rate stayed in the 0.28, 0.30 range for the first 3 months. Then at the beginning of the summer, as the first set of deferrals expired, the non-accruals jumped. And with the exception of a pause as schools reopened in September, non-accruals have continued to climb. The rate is now substantially above the C&I mark, which we haven't experienced since September 2015. Now we're looking at the 8 largest property types. And by largest, I mean the highest amount of loan outstandings. And here we're looking at the non-accrual rates, January 2021 versus December 2020. Non-accruals dropped for 3 of these properties, but were up for lodging and sharply up for mixed use and retail. Lodging is now closing in on 9%. Retail has jumped to 1.75 and is now the second highest, surpassing both healthcare and industrial properties. And one last comment on how fast the situation with lodging has deteriorated. The percent non-accruing for lodging was 0.13% as of May 31st, 2020. And now it's 8.84%, with the highest levels being seen in New York, Massachusetts, Illinois, and Texas. So now we'll move on to the credit quality as determined by the risk ratings. And on this chart, we've plotted the details of the trend in percent criticized, very similar to what you saw with C&I. And you can see the service low as of March 31st, 2020. I wanted to mention that again. In March of last year, we had a service low of 2.11%. Since then, we've climbed into the eights, reaching 8.9% in July. We've settled back down a little bit by the end of 2020. And now for January 21, we're back up to 8.23%. You'll also notice that the special mention ratings, the blue, peaked in July. And since that time, the percent substandard has increased as loans have deteriorated even further. And once again, here's our Zions inspired chart. And combining the percent of non-accruals and the accruing but criticized loans, we get a glimpse of the worst case scenario for the large property types. And what we find out is not only are lodging loans currently performing the worst, as shown by the red, with non-accruals just shy of 10%, but the potential for additional problems is extremely high, with a possible maximum of 45%. Healthcare and retail are a distant second and third at a possible 6.4 and 5.2% respectively. And if you put healthcare and retail into the C&I picture, the 6.4 and the 5.2 would be average or below average for most of the industries that are having additional problems, such as ag, admin, and of course, oil and gas, transportation, arts, and entertainment. So this chart is constructed the same way as what we did for C&I. We're looking at the percent change January 2021 versus December 2020 for each bank. And the results for this month are quite different from what we saw throughout 2020. For most of 2020, we saw at least some growth. A few banks had scaled back, but most had what I term moderate growth. Now, 62% of the banks, of the RAS banks, saw a drop in outstandings this month. And needless to say, we'll continue to track this measure in 2021, as it looks like the poor performance in CRE has impacted the desire to add assets. And one last CRE chart. We stay with our percent change in outstandings for each major property type, January versus December. And Stephen tagged this picture as a picture of my dog with its head on the right, the body and the two legs in the middle, and the tail on the far left. So with that image in mind, let me describe what's happening. So the head of the dog represents the only property with any growth to speak of, and that's the residential market. At the tail, you see statistically positive number for healthcare, but I think we'd all agree flat is more descriptive for that. The legs, or the other property types with the greatest declines, are lodging and office. And if you've been with us in the past, you notice the beginning of, or towards the middle of last year, the lodging loans were increasing as it looked. What we were assuming and finding out was that people were finishing the properties that were under construction. Now it appears that those properties have been finished and people are scaling back on lodging. So that's our analysis of the 2021 data, and a quick summation before I hand it back to Stephen and we open for questions. For C&I, delinquencies are up, but non-accruals and credit quality levels are better. For CRE, all the performance and credit quality measures got worse. And for both markets, growth is off. Now I'll hand it back to Stephen.
Thank you, Tom. Boy, it continues to be interesting month over month as things sort of go up and down, but a few constants in there, especially the lodging numbers, just very striking to me. So just a reminder, this is the section where we're taking questions. There's hundreds of you on today, which is great. We welcome everybody back who's a regular and anybody new. What we do here in this segment is you go down to your Q&A portion and you ask your question there in written form, and then we'll answer as many as we can here, or as many as there's interest. So we had a couple come in, but don't be shy. This makes the conversation, I think, pretty lively. You get to hear a little bit of the concerns of your colleagues across the country. First one from Victoria. Thank you, Victoria. Given the CARES Act has drastically changed the delinquency reporting, how can you draw conclusions from reported numbers? Wouldn't it be more appropriate to use CARES Act extension numbers, except that the regulators aren't requiring a segregation of commercial versus consumer loans?
So this is one of the challenges we've had since really since March, is how, particularly with the deferrals, how can we judge what's really been happening? And to be honest with you, there has not been an easy way to electronically gather the data to understand what the true, I call it the true delinquency rate would be. And we had asked a poll question back in April about, who was putting loans on deferral. And if I remember correctly, Stephen, I think we thought it was about 7% of the loans were on
Right.
deferral.
Mm-hmm.
So the numbers that you see here can be inflated by anywhere from an additional 0 to 7%, depending upon how many of those deferral loans were actually bad loans that that weren't going to pay versus we heard a lot of people put loans on deferral just because they asked.
Mm-hmm.
So that's been a challenge all along.
Yeah, right on. Okay, a couple questions on the CRE segment. One, does the CRE information include construction? And two, do you break out recourse versus non-recourse in the CRE section?
So the answer to that is yes, it does include construction. And yes, it does include recourse and non-recourse. And if you send me your name, shoot me an email, I can give you some details on what that looks like.
Okay, great. Thanks, Tom. And Colin, that'll be, I think, the next slide over. You'll get those email addresses on the screen. Next question comes from Jesse. Can you provide details on the owner-occupied CRE broken out from the C&I category?
Again, Jesse, we can. And if you'd send me an email, I can get you those. We do have commercial real estate that's owner-occupied split out as a separate category.
Okay. All right, terrific. And I just might make a plug. Tom takes those very seriously and gets back so quickly. I know that people that have done that before have appreciated that level of promptness. Our next question comes from Robin. With so many employers enabling staff to work at home these days, do you see more defaults in commercial office buildings? Do you think most of the corporate tenants will renew their leases, especially in the high-rise office building space?
So this is one of the main questions, I think, for the office space. What's going to happen? And I know my particular company, I'm here in my office building today, and I'm one of, I think, 3 people in the office today. So, and I think that, and looking around the office park, I saw the same thing. So I would say I've got to believe that what will happen is as the vaccines and everything get rolled out, people will be offered the option to come back in, but a lot of people will say, no, I don't want to come back in for various reasons. And you'll see a lot of defaults in the office buildings, especially in the high-rise office building space, because of, in order to get to your office, you got to get in an elevator with a bunch of people. And so that will be a problem. And I know they've already seen in New York City, and I apologize, I can't remember the name of the company who has started, a fairly large company who did not renew their lease or has notified the landlords that they're not going to renew their lease. So I think you're going to see in places like New York, Boston, San Francisco, those places, you'll see a lot of high-rise office building space, at least temporarily, go vacant.
I tend to agree with you. And to add to your anecdote, I think, the RMA is looking at how we can deliver services with remote office versus being in person in our headquarters. So I know that our 2 companies aren't the only ones in the world. I do think that there is a demand for people to get back face to face. And I've also heard, Tom, that there's and I think we've discussed this on previous segments, but there may be some additional space requirements to give people, 6 feet of distance or more. There may be investments in ventilation, so I wouldn't count out that, commercial office buildings may still have a very strong and robust life. But here, I want to ask a follow-on question, or just get your thoughts, Tom, as we start to see this kind of play out. Leases are multi-year. I don't think we're going to see a spike in defaults necessarily. I think you'll see tenants sort of one by one, maybe backing away or not renewing. And that's going to be the stressor then on the owners. And then we'll start to see defaults. But I wonder what you thought, Tom.
I would agree with that. And that's some of the things I've read along those same lines, is that what will happen is people will, as their leases come up, they'll not renew them. And this will be a gradual versus, 2 years from now, we'll be looking at non-accruals spiked up, not spiked up, but just gradually rising.
Right
it won't be a shot like we've seen with lodging.
Yep, I think that's right. And we might also see some effects of the economy, wherever the economy is in 18 to 24 months. Okay, David asks, how have you seen cap rates moving in relation to loan quality trends in the various CRE segments?
So David, again, if you send me an email asking that question, we have some of that data. I can pull that and send it back to you. I don't have that handy right away.
Okay. Someone named Anonymous. Would you recommend adjusting EBITDA in regards to COVID-19 specific expenses? And if so, how would you recommend?
So that, I think, is a little beyond my accounting background. So I would pass on that. Stephen, I don't know if you have anybody at the RMA who could opine on that.
Yeah, I think so. So to the person who sent that in, when you see my email address on the next slide or so, I think we've got some folks that have definitely come across some COVID-related adjustments to spreads, and that might help frame the answer for you. And from the same questioner, are you seeing an increase in lending to REITs, the real estate investment trusts? Any concerns or considerations there?
So again, that's an area that we haven't specifically looked at, but we have the ability to break out. So if you could send me an email, I can get you some information on that. And where I would be concerned with REITs are particularly on REITs that have malls. Those are, matter of fact, right down the street from where I am is the Exton Mall, owned by Preet. And we know they've been having problems with that.
With some of the large anchors that are starting to pull out.
Yep.
Okay, question from Guy. Can you separate C&I into industrial and various kinds of consumer, specifically like retail, hospitality, and then the subsegments of hospitality of, say, luxury, non-luxury, any big trends within the category?
So we can do some of that. There's in addition to the NAICS codes, we have the OCC codes in here, and we also have, and Jeremy, correct me if I'm wrong, the GIC codes that give you the capability of doing some of this.
Yeah, Tom, and just building on that, we have the ability in RAS, you can customize industry segments. So banks that subscribe to the service, they can recombine NAICS to create any type of industry hierarchy. We've actually taken a look at recently what we called COVID sensitive industries, where we looked at things like hospitality and luxury. And in terms of some big trends in those sectors, we actually did see, in terms of loan growth at least, those industries drew very heavily during the onset of the pandemic, but then loan growth decelerated much faster for that group in the subsequent months. So there's some interesting trends there in terms of growth. Same with pricing and risk, certainly for things like non-accruals and delinquencies, industries like hotels and oil and gas and other industries that are really been hit hard by the pandemic. They definitely saw a much sharper rise in non-performing loans than other sectors. So yeah, definitely different ways that we can slice and dice industry. And if you focus on the ones really hit hard by COVID, most of the trends are what you'd expect.
Thank you, guys. Colin's got another question. Have you gathered data on loss severities or the loss given default in the CRE book?
The answer to that is yes. Matter of fact, we just did that back in November. So again, Colin, if you'd send me your email, I can show you the results there. And just to give you a quick snapshot, there's not been much change. It goes back to what Stephen was saying about the gradual, talking about office buildings, how gradually things might go bad. We have not seen a dramatic increase in LGDs yet. But again, send me your email and I can send that information to you.
Great. Doug asks, any insight into bank underwriting standards? Are banks starting to loosen standards for C&I loans or waiting for more clarity? And I might start off by saying we are not seeing a loosening of standards. I think the banks that we're talking to often are one, taking care of existing customers through things like paycheck protection. The two, sticking with their well-known relationship loans and having comfort there and not trying to go out on a limb. But Tom, I wonder if you're seeing anything different or maybe the same that we're seeing.
So it's the same. This is one of the things I look at every month. And the way I judge it, or one of the ways we judge this, is by looking at the number of or percentage of unsecured loans and seeing whether those have gone up or down. And they have been flat for, I'd say, the last 6 months or so. So I'm not seeing any change in underwriting standards.
Yeah. Yeah. And Stephen, just building on that too, we also look at things like the Senior Loan Officer Survey. And in the fourth quarter, banks on balance continued to tighten standards, to your point.
Mm-hmm.
It wasn't quite as severe as what happened earlier in the year in 2020, but we're definitely still on the wrong side of the ledger there. So definitely banks are still tightening. In that same survey, they also indicated that demand is still weak too from borrowers. So we're really in a pretty tough spot right now in terms of loan growth. But hopefully, like going back to the survey in the beginning of the webcast, some banks and some respondents do feel that things will improve this year, and hopefully we'll see a return to loan growth pretty soon.
Good point on the demand side, Jeremy. I just wonder if we were successful in bringing the economy back to sort of a normal stage, would we see demand snap back to where we've seen it before?
Right.
Okay, nice long question coming up here from Bryant. Thank you. I am involved with the consumer side of our credit review department. I'd like to know if the RMA can maybe share some of the demographic and some of the peer banks, such as the size of the institution, the number of credit review analysts in each department, how many analysts are tied to the consumer review products, what are the sampling techniques used, random or statistical, continuous, what's the size of the consumer portfolios? Thank you for any help. Yep, I think that's a perfect one that I could answer offline, Bryant. Feel free to email me and I can get you connected to the right information there, and maybe even the right person that can consult with you. And Tom and Jeremy, you're welcome to kind of weigh in on this. I think this is a little bit off of our RAS topic, though.
Okay. I would agree with that. Yep.
Okay. All right. Well, we're down to our last couple of questions. So once we're done with the questions, folks, you can, we'll be wrapping up. So if you do want to ask something, this is last call for questions. Doug asks, banks are supposed to cease making LIBOR-based loans in July. Any feedback on replacement rate options for bilateral loans, such as SOFR, Ameribor, something else?
So Jeremy, do you have any comment on that one?
Yeah, so we've been very closely looking at borrower index preferences over the last couple of years to see if there's been a shift away from LIBOR in terms of how banks are pricing loans today. I think in the immediate sense, we have seen banks making greater use of the prime rate. That's been one, I think, way they've been transitioning away from LIBOR, at least in the short term. Definitely hearing a lot more about Ameribor. Not sure if that's going to be a viable replacement beyond SOFR, but yeah, we're definitely seeing LIBOR loans beginning to decline in the data set, with more prime and fixed taking up the mix. And certainly we're watching very closely whether or not banks are going to make use of indices like Ameribor and SOFR. We actually in our database have noted a handful of bilateral loans that are now tied to SOFR. So we definitely think those trends are going to accelerate over the next few months, and we're really keeping a close eye on that.
Great. Thank you, Jeremy. Danny asks or makes a comment that I believe that a few things that keep CRE numbers, specifically the outstanding dollars, from moving down too quickly is that existing construction loans continue to fund up and that it may be a little bit more difficult for some loans to move to the permanent market away from the bank's balance sheets. Good point, Danny.
Yep.
All right. Last question that we've got queued up here from Evan. Do you think that potential stimulus measures will only continue to kick the can down the road on residential mortgage defaults and evictions? And if so, does the data not yet reflect the full potential impact COVID has had?
So in my opinion, the answer to both of these is yes.
Yeah.
I think that the PPP loans and other stimulus Main Street have disguised what's really happened with PPP, and what the full potential impact will be. I don't think we'll ever know, because I think some banks short of the some customers short of the PPP loans would have gone under. So, as a matter of fact, we were on the modeling, the RMA modeling conference the other day, and that was one of the topics that came up was how do you model with the year 2020, and people were saying you really don't know what the impact was, and you won't know until maybe 2022, 2023, because of the government stimulus.
I think it's fair though to assume, Tom, that there's more to come, right? It's how and when it unfolds.
Stephen, to be honest with you, that's always been my thought, particularly when you look at the chart that we showed, that's the Zions inspired chart, where you see, the potential, aside from lodging and aside from oil and gas, some of these other industries that are in the 10, 20% range with special mention, substandard, doubtful, and loss. The special mention kind of come and go, but the substandard and those others, which are pretty high, would lead me to believe that there's a lot that's going to go that won't ever recover, despite stimulus. And so I think we're going to see more. I just don't know how much more.
Yeah, good point. Well, great. Look, thank you everybody who have stuck with us, every month as we've been going through this, but today also. And Tom and Jeremy, it's always so insightful to have you on. So I appreciate your insights. We look forward to having you guys join us again in about a month's time. You can find all of that registration stuff on the website, rmahq.org. And I might put a call out here to an upcoming webinar that's scheduled. It's called The Impacts of Climate Change on the Financial Industry. That'll be next week on Thursday. It's March 4th at 1 p.m. Eastern. Again, you can register right there on the RMA HQ website. So Tom, Jeremy, that brings us to the end. I want to remind everybody that there's a survey at the end of this that will happen, and we do read the survey comments and look at your feedback in an effort to make these things better and more tailored. So kindly consider filling the survey out. And with that, thank you and have a nice day.
Thank you.